Imagine a world where your money loses value overnight, or where finding a job feels like searching for a needle in a haystack. Sounds scary, right? Well, that's exactly what the Federal Reserve is working hard to prevent. Welcome to the Economy Unpacked Daily YouTube channel. From Wall Street to your street, we share the world of money in a clear way. Today, we're diving into the heart of the Federal Reserve's mission, the dual mandate. It's a powerful concept that shapes the economic landscape we all live in, and understanding it is key to grasping how our financial world works. The Federal Reserve, often called the Fed, has two main goals given by Congress: price stability and maximum employment. Together, these form the dual mandate. But what does this really mean for you and me? It's all about balance. The Fed aims to keep the U.S. economy growing steadily, ensuring that prices don't spiral out of control and that job opportunities remain plentiful. Think of it this way: price stability keeps your hard-earned money valuable, while maximum employment ensures you have the chance to earn that money in the first place. Without stable prices, your savings could become worthless. Without jobs, the economy could grind to a halt. The dual mandate is the Fed's way of keeping both plates spinning. This balancing act didn't always exist. It was the Humphrey-Hawkins Act of 1978 that officially established the dual mandate. Before that, the Fed's role was less clear-cut. But the economic turmoil of the 1970s and 1980s, with sky-high inflation and unemployment, pushed Congress to define the Fed's responsibilities more precisely. Since then, every major Fed decision, from tweaking interest rates to implementing massive economic stimulus programs, has been guided by these twin goals. Let's break down the first part of the mandate: price stability. We're talking about keeping inflation in check. Inflation is when prices generally rise over time, while deflation is the opposite, falling prices. Both can be harmful if left unchecked. High inflation eats away at your purchasing power, while deflation can lead to a dangerous cycle of delayed spending and reduced investment. So what's the sweet spot? The Fed typically aims for a 2% annual inflation rate. It might sound counterintuitive to want any inflation at all, but this small, steady increase encourages spending and investment without letting prices run wild. It also provides a buffer against the risks of deflation. To achieve this, the Fed has several tools at its disposal. They can raise or lower interest rates, buy or sell government securities to adjust the money supply, and even engage in large-scale asset purchases during economic crises, a strategy known as quantitative easing. Now, let's turn to the other half of the mandate: maximum employment. This doesn't mean zero unemployment. That's not realistic or even desirable. There will always be some level of unemployment as people switch jobs, enter the workforce, or retrain for new careers. Instead, the Fed aims for the lowest sustainable unemployment level that doesn't trigger inflation. To gauge the health of the job market, the Fed looks at various indicators. The unemployment rate is the most well-known, but it's not the only one. They also consider the labor force participation rate, the share of people working or actively looking for work, and monthly job creation numbers. A robust job market is crucial for economic growth. When more people are employed, consumer spending increases, which drives about 2/3 of U.S. economic activity. It's a virtuous cycle. Strong employment boosts wages, productivity, and tax revenues, which in turn supports further economic growth. But here's where things get tricky. Sometimes the goals of price stability and maximum employment can conflict. Imagine a scenario where inflation is running high, but unemployment is low. The Fed might need to raise interest rates to cool down inflation, but this could risk slowing down hiring. On the flip side, if unemployment is high but inflation is low, the Fed might cut rates to boost job creation, potentially risking higher inflation down the road. This trade-off is at the heart of the Fed's challenge. They often have to choose which goal to prioritize based on the current economic situation. We've seen this play out in real time during major economic events. During the 2008 financial crisis, the Fed slashed interest rates to near zero and launched massive quantitative easing programs to stimulate job growth. More recently, in response to the COVID-19 pandemic, they took similar emergency measures to support both employment and price stability. However, as we've seen in the aftermath, these actions later contributed to a surge in inflation. The dual mandate isn't without its critics. Some argue that it's inherently contradictory, as inflation and employment don't always move in predictable ways. Others believe the Fed should focus solely on controlling inflation and let the job market adjust on its own. There's also debate about whether employment should take precedence, given its importance for social stability. It's worth noting that not all central banks operate under the same framework. The European Central Bank, for instance, primarily focuses on price stability. The Bank of England has a single inflation target, but does consider employment in its decision. The Reserve Bank of Australia has a mandate similar to the Fed's, but with slightly broader goals that include financial stability. So, how does all this affect our daily lives? The Fed's actions in pursuit of its dual mandate have far-reaching consequences. When interest rates rise, mortgages become more expensive, potentially cooling the housing market. Companies might slow down hiring when borrowing costs increase. Inflation can erode wage growth unless the job market remains strong enough to push wages higher. On the flip side, higher interest rates can benefit savers, though they make life harder for borrowers. Currently, the Fed faces significant challenges. In the wake of the pandemic, inflation has spiked to levels not seen in decades. At the same time, the U.S. job market has remained historically strong. This puts the Fed in a difficult position as they try to bring down inflation without causing widespread job losses. As we wrap up, it's crucial to understand that the dual mandate is all about finding the right balance. The Fed must work to stabilize prices while fostering a strong job market. It's a complex task, and sometimes these goals can seem at odds with each other. But in the long run, both price, stability, and robust employment are essential for a healthy, thriving economy. Transparency is key in this process. The Fed must clearly communicate its goals and decisions so that markets, businesses, and households can plan accordingly. By understanding the dual mandate, we can better grasp the economic forces shaping our financial lives and make more informed decisions about our own money and careers. Remember, the world of economics is unjust for Wall Street experts. It affects all of us on Main Street too. Stay informed, stay curious, and keep unpacking the economy with us. Until next time, this is Economy Unpacked Daily, helping you make sense of the dollars and cents that shape our world.